Hey, good day everyone, and welcome to Accounting with Naomi. I am so happy to have you guys back once again. All right, it is our exam period, and everybody is on that time where there is a whole lot of panic happening. Some of you are not sure if you are ready to write, some of you are thinking of not writing, others are studying, and your thinking cap is high. So yeah, there's a whole lot of things happening right now. So I just want to remind you guys, you were able to stay up until this long. This has been a year module. It's been the whole year. So that means you wrote different assessments throughout the year. You did quizzes, and here we are doing the exam, the final assessment. So I believe if you are here, if you are even in this class, it means you are ready. Okay, so you just need to build confidence, guys, because it's very important when you're getting into exam that you have confidence, because it is psychological. At the end of the day, as much as we're talking about theory, studying, and all that, it is psychological. If you don't have confidence, even if you studied, you may still feel like you're not ready. So I'm here to tell somebody that if you have reached up until this time, you can make it. You are ready and you can do this. So now, what you're going to do for me before we go on with our assessment, with our revision, exam revision, before we go on, please trust yourself. Trust yourself that you can do this, you have this, you've got this, and you're going to pass this. All right. So that's what you do for me. Weigh that confidence cap because you need it throughout the exam. Okay, so with that being said, guys, welcome to Accounting with Naomi. It's gonna be quite a long revision because this is an exam revision. So in this revision, I'm gonna work through the 2023 exam paper. Basically, it was the final assessment. So they had two alternatives. They had assessment 9 and they had assessment 10. Now, if you check last year, I think last year I did assessment 10, so you can go and have a look at it. I did a revision like that. It was the whole day revision on a Saturday. You can go and have a look at that one. It's assessment 10. Now I'm doing assessment 9. This was the final assessment. Assessment 10 was the alternative final assessment. So if you wanted to boost your marks and you do assessment 10, this is assessment 9. So it's basically the exam, right? The reason why I chose that question, because I wanted the exam level. Also, it covers most of the syllabus that you have studied or that you need to know for the exam. Almost everything is covered in the paper, which is very, very important, right? Of course, they cannot cover all the topics. It's impossible that you have all the topics, but they do their best to cover at least 80 to 90% of the syllabus within the question. Also, the standard differs. So whenever you are practicing for the exam, it is very important that you work through an exam level kind of question, like that difficult kind of question. Get used to it. If you can answer it, especially under exam time, it means you are ready to write. Okay, so yeah, choosing difficult questions is very important when preparing for the exam, because so that you don't get shocked when you actually finally see the question, the standard or the level of the question that you need in the exam. All right, so it's very important that you actually work on that level of the question. Right. So that's what we're going to be working on. And I know people are going to ask, where is the question, guys? I have attached the question. I'm going to send a link of the question on the description, right? So go to the description of this video, underneath this video, on the description underneath this video, and download the paper, okay? So I'll put it on the description. It is a link. Click on that link and download the paper. Then you have a question and you can follow along as we work on it. All right. So yeah, guys, what do you need for this question? So you need to have a clean page, have a book or somewhere where you're writing, very clean page. Then have your pen with you. Have a highlighter. If you're going to print the paper, you're going to follow with the printed paper, you can print it and have a highlighter to follow through. And most importantly, have your financial calculator. And I'm being very, very specific, guys. It has to be a financial calculator. Now, I'm sure you guys wanted to see my face and everything, but yeah, I don't think I was ready for that. Yeah, so that is why, but I am with you guys. Also, I'm having network issues. I've noticed that. Um, I've been having network issues for a while because I wanted to actually like look at you guys, speak to you guys. Like, I wanted it to be live like that, but because my network is being it has not been too strong, I think that will be a very big risk at this point in time. So I am pre-recording the class, and then we'll have it being premiered. So I will watch with you guys together while it's being premiered. So if you have questions, please put your questions on the comment section. And in fact, don't even hesitate. Ask immediately and I will answer you guys because I will be with you guys while the video will be premiering. So any question that you post, I will answer immediately. Okay, so yeah, I'm with you guys. And yes, before we continue, if you are here right now, like this video. First thing you do, once you join, you like, sorry guys. Once you join the class, you like immediately. Then, secondly, share the link with somebody. Okay. Besides, share it on the group. Any FAC group that you are in, share it with them because they also need this. Don't be stitchy, guys. Knowledge is for all of us. So they also need this class. So any group that you are in, whether it is Facebook, WhatsApp, Telegram, whatever group you are in, share this link and tell them, hey guys, a revision class has started, you know, in accounting with Naomi, join. All right, so share the link, please. Let's do that. Let me give you guys like 5 minutes. Go and share the link. Make sure you like, say something nice on the comment section. Yeah, say something nice on the comment section. You know, let's get to know each other. Tell us where you're watching from, who you are. Yeah, so that's it. Like, share, tell people to come and join. Let's spread this, guys. You can even put it on your status. Let's spread this class so we can have more people coming in. And the more people come in, YouTube will actually push the videos across. Okay, so yeah, let's do that quickly. Tell us where you're watching from. Who are you? We want to get to know you. Hey, and most importantly, if you haven't subscribed, please subscribe now. Subscribe now, like the video, share the link with somebody. Say something nice on the comment. Tell us who you are. Let's get to know you. Let's get to know you. Let's share, let's like, let's subscribe. All right. While we are busy with that, like I said, if you are just joining us, the question is on the description under the video. There's a link. Click on that link and you can download the question to follow along. So with that being said, guys, let's get straight into our class for today. Right. Okay, so we are working through assessment 9, like I said, the 2023 paper, which was the final assessment exam. Basically, this was their exam. As you can see, it was 100 marks paper. That's how your paper is going to be. It's going to be 3 hours, 100 marks. Okay, trying to cover at least 80 to 90% of the syllabus. Yeah, so that's basically it. So what do I do once I see a question? All right. So the first thing you do, guys, once you see a question, number one, confidence, please. I cannot continue to stress how important confidence is. Very important. You have to be positive throughout the paper so that your brain can function. Because guys, if you panic, you're going to have a brain freeze. We are avoiding brain freeze. If you panic, guys, there's going to be a problem. So do not panic. Do not panic. Be confident. So when you see a question, it happens that your heart will go boom, like, what is this? You don't want that. So you are already coming there and say, whatever I'll find today, I'm gonna pass it. I'll know what to do. I've studied, I practiced. All right, so you're gonna have to trust yourself in that level, guys. Let's continue. So once you see the paper, of course you will, unless if they give you a table or something. Okay, this one they didn't give. Other papers, they may give you a table of what is being tested in question 1 and 2. I see here there's no such. So you go straight to the required. You are allowed to start with question 2 if you feel like. If you want to start with question 2, usually question 2 will have groups. So if you're like a fan of groups, you can start with question 2 if you want, but you have to do it in full. You cannot do question 2A and then you come back to question 1C. That is going to be a disaster. You may lose marks for doing that. So if you decided that you're doing question 1, this is what you do. Before you read through the scenario, make sure you read through the question section. All right, question first before you read through the scenario. Okay, so let's go. It says here, prepare all the relevant journal entry to correctly account for the manufacturing plant in Calfontaine in the accounting records of Coral Limited for the year ended 30 September 2023. Whoa, very important. I need to know what is the instruction. Secondly, which company am I working with? Thirdly, which financial period? It's very important. If I don't know the company, I may be listening to different names. I won't know whose books I'm doing. And then the financial period, I need to know my financial period because in accounting, we always work with 12 months. And you're not supposed to work with before or after the financial period. You work within the financial period, which is usually 12 months. So here they give us the year end. You are able to predict, to tell the beginning from the year end. All right. So that's very important. Then the instruction. If I don't know what I'm doing, then I'm doomed because what? If I don't know the question, if I don't understand the question, I won't be able to answer it. So it's very important that I pick the instruction. The instruction in simple is that you're going to do journals. Journal is based on what? The manufacturing plant in Calfontaine. So that's what I'm looking out for. When I'm going to read my scenario, I'm looking for manufacturing plant in Calfontaine. What is it about? Anything that affects that manufacturing plant in Calfontaine, I'm going to have to generalize it. But within the current financial period, which ends in 30 September 2023. It goes on to say, journal narrations are actually required for this question. I know most times they don't ask for journal narrations, but in this question, unfortunately, it is required. The dates are not required. Now, I know as much as they say the dates are not required, I always advise students when you're doing journal to put dates because it's, it actually helps you get the journal when you put the correct date because you're saying on this particular date what actually happened. So you are reporting. Guys, a journal is more like a report of an event, but in using accounting language. So I will report an event better on a particular day that it actually occurred. And then the journal on that day versus the journal at year end is two different. Right? For example, if I purchase a vehicle now, I'm actually recording it at cost. But at year end, the vehicle has lost value. I have to account for depreciation. So you see, the dates are important. It tells you what journal to put on what date. All right. So it's very important. Then they say the tax consequences can be ignored. And most times when you're doing journals, they will not want to also test taxation at the same time. So most time they wanted to ignore the effect of tax under journals because you want to focus on those particular accounts and not necessarily on the tax account. If you want to test taxation, we'll usually test it differently, right? But anyways, follow the instruction. Instruction is simple. They want narrations. Narrations, guys, there's no way I can say this is a specific narration. Narration just simply means an explanation of the journal that you've just done. Okay. I don't think anybody should ever get narrations wrong. Anyways, the mark allocation is 14, and then you get one more mark for communication mark and presentation. Right? In other words, if you do it, you're giving us the right journals, you're putting it in the right format, all of that, you get a 1 mark. Usually these marks are just there to boost students so they can pass. Okay. So yeah, that's the first question. We're doing journals. Then the second one is an 18-mark question. That's quite a lot. It's an 18-mark question. So what does it say? It says here, disclose the property in Matatiele in the accounting records of Coral Limited for the year ended 30 September 2023 in accordance with the requirements of only IS8, accounting policy change in estimate and error. So whatever I'm going to disclose right now, whatever notes I'm doing, either it's a change in accounting policy or it's a change in estimate or it's a prior period error. Guys, when you get this kind of question in the exam, just celebrate because these ones are straightforward, like straightforward. Any of the notes here should be straight unless if your foundation is not that good, especially when it comes to prior period error. If I don't know what is an error, I can't fix something that I don't know. But this, guys, 18 marks, you celebrate, you jump. Right, and it's 18 marks. It's a lot of marks for just a note. So here you're going to do it. You're going to disclose a note between a change in accounting policy, changing estimates and error. Now, for you to know which note exactly this is, you're going to have to go and read under the property in Matatiele. Then you will know if it is a change in estimate, accounting policy, or error. Okay, and that's 18 marks. So when we are doing this, we're actually preparing our mind to what to expect in the scenario. Also, we're getting our head to remember what it studied. All right, this is very important at this stage. Then lastly, C, it says advise the Chief Financial Officer, the CFO, on the accounting implication, including measurements, very important, on the decision to sell the Zwanga division in the accounting records of Nkoro Limited on 1 July 2023. Limit your measurement discussion to 1 July 2023. Guys, they're not saying a year ended. They're saying a particular day, not the full year. So you're limiting your discussion on this day. In other words, this one will probably be the initial recognition or whatever date that is. But your discussion is focusing on that one particular day, which is 1 July 2023. There is a support your discussion with calculations. You are allowed to do calculations to support your discussion, but remember it is a discussion. So if you turn this into a calculation, you're going to lose a lot of marks. It is a discussion at the end of the day. Okay, so most marks should be given on the explanation and not necessarily on the calculation. But if the explanation is already there and the calculation just need to support, then it's fine. Do not include any text-related discussion or calculations. Again, text is being avoided. I think I've said it several times. If they really want to test taxation, most times they will just go straight to ask you on text. Or if the question is just open and there's a taxation effect, then you just deal with it. But most times, especially for journals, most times they don't want you to include text journals. All right, again, guys, this is 16 marks and another 1 mark for communication. And that's basically 17 marks. So it's quite a lot. The way that they did this paper already, it means every question is important because look at it. The first one is for 15 marks. The second one is 18 marks. The third one is 17 marks, making up 50. The third question making up 50 marks. So all questions are important. There's nothing that you can say here. This one is not important. All are important. Okay, so we're starting with our question 1. We're going to deal with question 1, then we deal with question 2. So again, guys, you are free to choose which question you're going to start with, whether it's going to be question 1 or question 2. It's up to you. Right, continuing. So then we read further instruction. It says, please note your answer must comply with the requirements of International Financial Reporting Standards, IFRS. Round all calculation to the nearest rand. Most times we actually don't want to see any decimals in accounting. Most times we are rounding off our figures. All right. Comparative amounts are not required and accounting policy notes are not required. Here we're not talking about changing accounting policy. We're talking about accounting policy. They're different. Accounting policy is never examined, but when there's a change, we actually examine it. Okay. Overall, 50 marks. Meaning the paper is actually divided into 2. Question 1 being 50, question 2 being 50. All right. So then we are going to attack. Once you have read through, you know, okay, I'm expecting journals. This is a property. Manufacturing plants in Calfontaine. I'm expecting journals, right? Then I have a property that I have to deal with to do a note, disclosure note, to either change the accounting policy, estimate, or error. Then I have to actually deal with the decision to sell a division. That will probably be a disposal group. That will be a disposal group. Okay. So non-current asset held for sale. That's what I'm expecting. So already prepare my head. I prepare my head. I'm thinking, oh, what is it that I need to know because of this and that already. So then I go straight into the scenario, and then we now are saying, okay, let's go and attack this. Let's go and kill this. Now, you have to keep that positive energy throughout, guys. Throughout. Okay. Again, before we continue, if you're just joining us, please make sure you like the video, you share the link, and tell us where you are watching from. Greet us in the comment section, guys. Let's have a conversation. We are answering all the questions, okay? Let's have a conversation. Remember, this is pre-recorded, like I said in the beginning, because of network. I decided to pre-record, but we are premiering. We are going to premiere together. So we are basically watching together. If you have a question, you can ask me immediately and I'll answer you on the comment section. So let's be busy. Once you join, say something, greet us, tell us where you're watching from, on the comment section. Like the video, share the link in other groups and on your statuses. Let's get more people here. Anyways, let's go back. So we're going to answer now question 1. Okay, question 1A. All right, in my A, I am doing journal, right? So I know that my journal will take on this form. So I have here debits. On the side, I've got credits. I know my lines are not that accurate, but yeah, as long as it's clear and you guys can see it. All right, so that's basically what I'm doing in A. Now, very important, guys, always have your timeline. So I was told that the financial period is 30 September 2023. That's the year end. So always have your timeline to looking at you so that you don't make any mistake, because whatever we do, we work within our financial period. So at the top, my timeline, 30 September 2023, meaning the year starts in October 2022. This is my year end. This is the beginning of the year. Right, so that's my financial period. Whatever I do falls within that time. Now, let's go to the scenario and read to find what are these journals that are actually affected. Okay. So we go to our scenario. Starting from the top, before we even actually go to the manufacturing plants in Calfontaine, before we go deep, we have to first understand the background information about the company that we are dealing with. It's very important as well to know the kind of business that we're actually dealing with, especially if there is revenue question. It becomes easier when you know the kind of business you're dealing with. Right, so let's go. Coro Limited, in short, Coro, is a South African-based company that specializes in the designing, manufacturing, installation, and servicing of wind turbines. The company is primarily listed on the Johannesburg Stock Exchange, as well as dually listed on the Lusaka Stock Exchange. So it's listed both in Johannesburg Stock Exchange as well as Lusaka, which is in Zambia. And has a 30 September year end. Okay, so they deal with wind turbines. Okay, now with that being said, let's go straight to what we are dealing with, where we actually need to get our journals. Right, manufacturing plant in Calfontaine. On 1 February 2021, guys, dates are very important in accounting. When you see a date, you highlight, you underline, make sure you just remember it. In 1 February 2021, Coro acquired a vacant piece of land for an amount of 3,500,000 with the intention of constructing a manufacturing plant. The construction of the manufacturing plant commenced, so we have construction commenced on 1 May 2021, so that's after Feb. On 1 May 2021 and was completed on 1 July 2022 at a total cost of 8.8. This is not on building. 8.8, excluding the health and safety compliance cost below, which were paid in cash. Management considered the land portion of the manufacturing plant to be significant, so that it actually is important. The portion of the land is significant. Okay. To comply with the health and safety standards, an inspection was conducted at a cost of 250,000 on 1 August 2022. The inspector issued a compliance certificate which confirmed that the plant complies with all health and safety standard regulation in South Africa. Now, when you're looking at this, guys, this compliance certificate, it means that the manufacturing plant will actually not function if we don't get this compliance certificate. So this cost that is attached to this should be actually capitalized to the cost of the building. Okay, so yeah, there we have where was I? The inspector issued a compliance certificate which confirmed that the plant complies with all health and safety standards, regulations of South Africa. The plant was available for use. Very important. This is when we're actually going to account for these plants. It was available for use as intended by management on 1 August 2022 and was brought into use on the same date. On 1 August 2022, the plant was estimated to have a 15-year useful life and an estimated residual value of 950,000 was allocated to it. Okay, so for depreciation purposes, I have my cost. I have my directly linked cost or initial direct cost, if you call it like that. I have my useful life and I have my residual value. So for depreciation purposes, I'm on stage. Now remember, we start depreciating when the asset is available for use. So in other words, not on July, but actually on August, when the asset was available for use. During the 2022 financial year, the manufacturing plant did not operate. Wow. It did not operate due to the stringent COVID-19 restriction, which affected the cash generation capabilities of the manufacturing plants. But on 30 September 2022, Nkoro estimated that the fair value less cost to sale and the value in use of the plant amounted to 8.5 and 8.2 million respectively. On 1 May, so that was in September 2022. That was that year ended in September 2022. Then on 1 May 2023, Nkoro's management decided to lease out the manufacturing plant to Gole Limited. The lease agreement contains a lease in terms of IFRS 15. So firstly, we've been talking on the land. Basically on I-16, we're talking about PPE. Basically, we have been dealing with PPE and everything that has to do with PPE. And then later on, they introduce us to its recoverable amounts, basically. The fair value less cost to sale and value in use, which means we are now being introduced to impairment. So we're busy with PPE, now we're introduced to impairment. And now we just moved from impairment of assets to lease. We've now been introduced to lease. See, this is how they integrate topics that you know, so it makes sense in the question. Now, if you are not practicing from an exam type of question, you won't be ready because you are used to questions being done individually. Now they're being fused together. So you need to get used to this language where questions are actually fused together. Okay. So let's continue. Where was I? The terms of the lease agreement are as follows. Commencement date of the lease is on 1 May 2023. And then there's a monthly installment paid in arrears at the end of each month. It's 150,000 rand. There's a yearly increase of 10%. Usually this happens on an operating lease, where there's a yearly increase. It's rare for us to have a yearly increase under a finance lease. Anyways, let's continue. The lease term is 3 years. Ownership of the manufacturing plant will not transfer to Gole Limited. Now, remember, this is not enough for us to say this is it's an operating lease, because some finance lease also ownership is not transferred, right? But one thing we've picked so far already, that yearly increase usually happens with the operating lease, right? And also, guys, the lease term is 3 years, while the asset's useful life is 15 years. So 3 years out of 15 years, if I have to take 3 divide by 15 times 100, that's only 20%. So only the lease is only being used, leased out, the assets only being leased out for 20 years, 20% of its useful life. That's not the major part of its useful life. Therefore, it's not a finance lease. For it to be a finance lease, the assets must, the lease term of the asset must be for the major part of the life of the asset. All right. So which like more than 50% of its useful life, but this is 20%. So it's not a finance lease. This is definitely an operating lease. Anyways, let's continue. Gole Limited does not have an option to buy the manufacturing plant no option to buy the manufacturing plant from Corey Limited at the end of the lease term. Goes back to ownership not being transferred. All right. And at inception of the lease, the present value of the lease payment does not amount to the fair value. This one also tells you that this is not a finance lease, because for a finance lease, the present value of the lease payment should be equal to or more than its fair value. Okay, so yeah, that shows you that it's an operating lease. Then on 30 September 2023, the fair value less cost to sale and the value in use of the plant was determined to be 8.150 and 8,480,000 respectively. The estimated useful life and the residual value of the plant remained unchanged throughout the period. Right, so the question says we should generalize, but for the 2023 financial period. So I'm going to read it again. After reading the scenario, I'll come back to it just to be sure of what I'm answering. So it says, prepare all the relevant journal entries to correctly account for the manufacturing plant in Calfontaine in the accounting record on Coro Limited for the year ended 30 September 2022. So we actually limiting this to the 2023 financial period. That is how much we are limiting it. So in the 2023, what happened? If you look at before then, the 2022, here they introduced us to the asset, the construction cost, and all the cost that was attached to it. Then they tell us information about depreciation. Then they told us that the asset at some point was not actually put in production, and so they had to calculate impairments, and then that was for the 2022 financial period. Then in the 2023 financial period, which starts in October 2022, then introduce us to the lease agreement. So the lease agreement falls within the current financial period. And apart from the lease agreement, we also have to calculate impairments. Right, remember we have impairment loss, we also have impairment recovered. So you can see in the past there was impairment already in the past in 2022. It did give us the information to calculate impairment, and then in 2023 again it gives us the information. So it means if it was impaired before, it can now have a reversal. It's possible. Right, so we need to consider that. So our main focus is the lease, the operating lease. Now, with an operating lease, even though the asset is with someone else, we are still accounting for the asset as if it is with us, and the depreciation is still being calculated by us under the operating lease. So it's not the same case with a finance lease where we'll treat it as if we have sold the assets. Okay, so it's different. So basically, I want journals of the operating lease, and I want journals of the impairment, as well as of course depreciation. Of course, depreciation, right? Yeah, so that's basically what we're looking into in our lease. Okay, in our journal, sorry. But now before I can actually do my journal, it will be very important that I do the calculation. So that is why I put my format. Let me just bring this down a bit. I put my format there, and then I'm gonna go here and label these as calculations. Please always label, make sure your stuff are clear to be seen, and you must cross-reference. So let me start with the operating lease. Let me start with the operating lease question. Now, under an operating lease, guys, what we really want the most is equalized payment or straight-lined income. Should we call it income because we are the one leasing? Equalized lease income or straight line lease income or weighted average lease income. We want that, especially the fact that it actually is increasing by 10% every year. Now, remember the lease term is only 3 years. So the first year is fine. The other 2 years, it's increased by 10%. So you want to know that. So you want to calculate that average. That's the one that will constitute our income. And then the bank amount is the actual amount that is paid. So we are comparing bank versus the equalized payments to know if we have uh, um, income received in advance or accrued. Okay, anyways, let's do this. So first thing first, I want to calculate the equalized or straight lined operating lease income. Once I know these, I'll be able to do my calculations. Well, so let's start. Year one, what was the agreement? So according to the lease, it's 3 years. You're making a payment of 150 every month. Every month at the end of the year, sorry, end of the month, every month you're making a 150,000, and then it begins to increase yearly by 10%. So the first year there was no increase, so we had 150,000 multiplied by 12 months, right? So that's my year one. Year two, the 150,000 has now increased by 10%. So 100% plus 10, that's 110%. Divide by 100 in decimals, this is 1.1. 1.1 means 100% plus 10%. Okay. So it increased by 10%. And remember times 12. This is year. So this is my year one. This is my year two. Then in year three, this particular amount has increased again by another 10%. So it is 150,000. First of all, this was the first increase, and then this is the second increase, another 10%, right? So multiply by 12 for the whole year. So that's my year three. So I have year one, year two, year three, and then I can put this in brackets. Okay, so for the year, this will give me the full amount for the year, and then to get the average, I'll divide this by 3 years, which is the lease terms. All right, so then let's calculate the smaller bracket first, then we do the bigger brackets. Okay, so let's do this. So we take 150,000 multiplied by 12. So that would be 1.8 million plus 150,000 times 1.1 times 12. So that will be 1,980,000 plus 150,000 times 1.1 times 1.1 times 12. That will be 2,178,000. Okay, then do this 3. They're going to divide by 3 to find the average lease income per year. Right, so then we add them together. We have 1.8 million plus 1,980,000 plus 2,178,000. Right, so it gives me 5,958,000. So that's what we're expecting in total. Then we divide it by 3 to find the average per year. This is getting the average. So we divide this by 3, and in average, it is actually 1,986,000. This is per year, per annum, in average. Okay, in average. So that is my equalized. Let me even just underline it in a different color. Okay, now does that mean that actually how much I am receiving? Or the actual money I'm receiving is not necessarily equal to this what you call, it's not necessarily equals to this lease, operating lease amount that we're talking about. Okay, it's not necessarily equal to it. But yeah. All right, let's continue. How much would they actually receive in the year? So when did this start? Very important. When did the list start? The list actually started in May 2023. They started in May 2023. If I go back to my timeline, May is sitting somewhere here, maybe here. 1 May 23. That's when the lease actually started. So it has not been with us for the full year. So for this particular year, it's May, June, July, August, September. May, June, July, August, September. That's 5 months. So in this particular year, it's actually been here for only 5 months. Now, I want to now account for my I want to do my journal for this year. Remember, we are dealing with 2023 financial period. We are told to deal with the 2023 financial period. I want to account for my journal. So I'm going to have an operating lease income, and then I'm going to have money that I actually received this year. And then the difference between them will either be either it is accrued or it's income received in advance. Okay, so let's do that. So my debit will obviously be the money that I actually received from the operating lease this year. So that will be bank. This is now the money that was actually paid. So bank statement of financial position. I'm going to do my calculation here. So remember, it's only going to increase after a year. But actually, we are in the first year and the first 5 months. That means it was still 150 that we actually received. 150,000 rand multiplied by 5. We've only did this for 5 months. Oh, so we only received money for 5 months this year. You guys see where the 5 months is coming from. The list started in 1 May and the year ends in September. So 150,000 times 5, so that is 750 rand. We only received 750,000 rand this year. And then we're going to have our operating lease income, which is the average operating lease income. That average should be the same. This is profit and loss. That average should be the same every year. Like that's how we're calculating the average, the equalized, straight lined lease payment. All right. So I am going to use this my calculation that I did. So for the year, every year we're expecting it to be 1,986,000, right? Right. So I'm going to take that. Let me just do this. 1,986,000. That's for the year. Only 5 months has passed. Only 5 months has passed. So we're saying that 1,986,000 times 5 divided by 12. So basically, what we could account for is only 827,500. That's in average. All right, that's in average. So we accounted for, we recorded our operating lease to be 827,000, while the actual money received was only 750,000. So definitely we have an accrued income. Okay, it's an accrued income. We haven't received the money for it, but we are already accounting for it. Okay, so it's an income. It's more like an asset, accrued income, or you can even see receivables that should also be taken, right? So accrued income. Or if you say operating lease income receivable, that should also be taken. Statement of financial position. This is actually the balancing figure, the difference between the two. 827,500 minus 750,000. That would be 77,500. Okay, so this is the difference between the two. All right. Now they wanted us to do a narration. So this one, we're just gonna say this is recognition of the lease operating lease income received during the year. Recognition of the operating lease income receivable and the income received during the year. Okay, anything that makes sense. Remember what I said about narration? You are explaining what you are doing, although they did say they wanted narration. So you are explaining what you are doing. So guys, for the operating list, guys, the journal is always like this. When it comes to operating list, this is actually it. The journals are always like that. There's nothing else when it comes to this. Of course, we have to account for depreciation for the year and the rest of the stuff. So I just wanted to start with the operating list. I believe it's straightforward. Don't forget to make reference where this is coming from. It's calculation number 1. All right, let's look at the asset itself. Calculation number 2. Let's look at the asset itself. Okay. So with this, there was a lot of places where we had to calculate a recoverable amount and so there is also a possibility that we may have impairment reversal or impairment loss. So I'm gonna have the historical carrying amount and I'm gonna have the actual carrying amount. Historical meaning the one without impairment. Okay, so I'm gonna do it like this. So I have historical carrying amounts without impairments. In case somebody does not understand what I'm saying, without impairment, né? Versus the actual carrying amounts, including impairment. Okay. So that's how we are going to deal with our assets. Right, so let's start with its costs. The cost of the assets at 1 August 2022, was it? When was each available for use? 2022. Right, so let's start with its cost on that period. So first of all, the construction without health and safety cost was 8,800,000. Then plus the inspection or the compliance certificate cost of the health and safety standards, that was 250. That is directly linked cost because the asset was not going to operate if we didn't get these compliance, all right, compliance certificates. So yeah, that would be my cost. Therefore, 8,800,000 plus 8,800,000 plus 250. So that becomes 9,050,000. As you are welcome to calculate along with me to confirm these figures. Okay. So yeah, there we are. We have our cost, and then comes the depreciation. So I want to calculate this up until basically I want to skip to carrying amounts at 30 September. That would be in that 2022 financial period before we get to 2023. Okay, so I want to skip to that 2022, and in between, of course, we're gonna have depreciation because this is a depreciable assets. Depreciation. We're dealing with the depreciable assets, all right. So our cost is 9,050,000 minus we had a residual value that we're given here. The residual value was 950,000. The useful life is 15 years, right? So 950,000 minus that over 15 years. Now, for how long have we added? From August to September. So multiply by, let's count August, September, 2 months. August, September. Basically, because it was available for use in August 2022, and we are calculating up to September. So yeah, that's basically 2 months times 2 divide by 12. So that's my depreciation for the 2022 financial period. So yeah, let's do this. 9,050,000 minus 950,000, which was the residual value. We take that, we divide by 15, and then multiply by 2, divide by 12. So it was basically 90,000. That was my depreciation for the 2022 financial period. So my depreciation is actually 90,000. Remember, guys, you're supposed to have a calculator so you can calculate along with me. All right, so we have here 90. That was the depreciation for 2022 financial period. Then, therefore, the carrying amount will be 9,050,000. 9,050,000 minus 90,000. So I'm getting 8,960,000. 8,960,000. So that's basically where we were sitting. All right, and then there was an issue on impairment. All right, so when you come to this information here, I'm being told at 30 September, this is their fair value less cost to sale and their value in use. So with this information, I can actually calculate impairments. Impairment happens when the carrying amount is actually bigger than its recoverable amount. All right, so we're gonna know our recoverable amount so that we can be able to say how much is our impairment. All right, so I am gonna put impairment loss here. Let me put impairment in red. So sorry guys, my pen had stopped writing, but now it's back. So I'm gonna have impairment loss. Right, so I'm gonna have impairment loss here, and then to calculate impairment, let me use blue. All right, I need to know what is my recoverable amount so that I can be able to calculate impairment. So my recoverable amount is the higher of either fair value less cost to sale or value in use. So okay, so the amount, let me bring this down because we are still busy here. Right, so the amount, according to the amount that we're given, the fair value in use is 8.5. Fair value less cost to sale, sorry, this is 8.5. 8,500,000. And then the value in use is 8,200,000. Therefore, the higher is actually 8.5, which is the fair value less cost to sale. Right, so with that, now I can calculate my impairment. With that, I can calculate my impairment. Back to there. So impairment will be the difference between the carrying amount, which is 8,960,000, minus the recoverable amount, which is 8.5 million. So 8,960,000 minus 8,500,000. So that is 460. Now check what happens here. The 460 is only going to affect this number here. It's including the impairment. So here I'm going to minus my impairment, and then here I will not. So now just make sure this is a bit straight. I actually have a ruler. Well, I don't know why I don't like using the ruler. I feel like it's waste my time. Remember, I'm explaining and writing at the same time. So most times I just want to do my writing quick while I'm explaining. Anyways, let's continue. So yeah, that is my impairment loss. You guys saw where the impairment loss is coming from. We had to calculate recoverable amount and so yeah, that is where we're sitting at this point in time. We are actually sitting, the carrying amount is now as follow. So on my historical carrying amount is 8,960,000, and my actual carrying amount, which is 8.5, the one that actually includes the impairment. Okay, now we are in the 2023 financial period. In the 2023 financial period, we are going to continue. We're going to have depreciation for the year, and we are going to we have depreciation for the year. The historical cost continues the normal depreciation. The what you call the other one, the other carrying amount will have depreciation, and we have to still account for the recoverable amount. So check what happens. We're in the 2023 financial period. In other words, I want the carrying amount at 30 September 2023. That's what I want. Okay, then in between, of course, I'm going to have depreciation for the year, right? So we're going to do this in two. The first one is the original one. It's still the same. Remember, it's straight line, so it's still 9,050,000 minus 950,000. The norm, the same way we had calculated our depreciation before. Divide by 15. This is a full year. So it's a full year. That means 9,050,000 minus 950,000, which is my residual value, divide by 15. This is going to be 540,000. 540,000. That is my depreciation. Then for this one, we're going to calculate depreciation. So I want to explain this one properly so that we all get it. So here we calculate depreciation using the carrying amount that we actually have here and the remaining useful life. Okay, so we need to know what is our remaining useful life for us to actually be able to calculate that. Let's do this on the side. Let's do this on the side. So 15 multiplied by 12. 15 times 12, that is 180 months. Okay, so far before we got in here, we calculated depreciation for what? 2 months only. So 2 months has actually passed. Therefore, minus 2, that is 178 months remaining. Very important. So I want to calculate my depreciation using the 8.5. Okay. Right. So we're going to do it this way. Our depreciation here will be 8.5 million minus the 950, which is the residual value, over, I'm not losing the 15, I've changed it to months, and the remaining is 178. So over 178 months, and then during the year, 12 months times 12 months. 12 months has actually passed. So we are saying 8.5 million minus 950,000. This divide by 178 months, multiply by 12. Okay, so I'm getting 508,989. Okay, so yeah, that's basically it, and that is my carrying amount, my historical carrying amount, and my other carrying amount that actually included the recoverable, impairment. So remember, guys, once an asset is impaired, we're no longer using the original cost to calculate depreciation. We have to find how much of the useful life is still remaining, and we need to calculate depreciation based on the carrying amount that we had, because of the fact that it was impaired. Okay. Oh, by the way, you guys need to have water always with you when you're doing accounting. The brain needs to be refreshed. All right, so let's calculate the carrying amounts. Let's start with this one. 8,960,000 minus 540,000. This is 8,420,000. All right, so that's my carrying amount. Then my historical carrying amount, my other carrying amount is a 50,000 minus 508,989. Oh, it's not 850, 8,500,000 minus 508,989. So I'm getting 7,991,011. Okay, so this is where we are actually sitting at. Now, in 30 September again, there was again they gave us the fair value, the recoverable amount basically. So we have the recoverable amount there as well. Now, remember, for us to have an impairment, it means the carrying amount must be bigger than the recoverable amount. Okay, by the way, let's calculate our recoverable amount. So I want to calculate my recoverable amount. Now this is in 2023. So in 2023, recoverable amount again is higher of either fair value less cost to sale, or value in use. Whichever is the higher will have actually the price, right? So the fair value is 8,150 and value in use is 4,840. 8,150 and this one is 8,480. Okay, so that's basically my, and therefore the higher is actually 8,480, the value in use. So if you look at my recoverable amount, is actually bigger than my carrying amount. So this is supposed to be this is supposed to be what you call fair value, impairment, sorry, impairment, recover, reversal. Okay, reversal of impairments, or impairment reversal. Right, we're supposed to have impairment reversal. Now, this must always be limited to the historical carrying amount, not the carrying amount that had impairment. All right, so we're going to have here, let me put this in green so we can see this, impairment reversal, impairment loss reversal. All right, this impairment loss reversal must be limited to the historical carrying amount. That was the whole point why we had a historical carrying amount from the first place. So it cannot go beyond that, because you know what's going to happen. If I use the carrying amount that has impairment, the reversal is going to be very, very high. Okay. So I must limit it to the impairment that was already done before, in other words, basically. And to do that, I must use the historical carrying amount. So how am I now going to calculate my impairment? So I will take the recoverable amount, which is 8,480,000 minus, here we have 8,420,000. 8,420,000. So this is limited to the historical cost. It cannot go above. It cannot go above it. All right. So it has to be less. Whatever it is that we're gonna use has to actually be less. Sorry, guys. No, I didn't explain it now. It's limited to. So if you look at this amount, it cannot go above. Therefore, my limit is what I need to answer to. My limit is that it's not going to go above 8,420,000. 8,480,000 is already above 8,420,000. So I'm limiting it to 8,420,000. That's where the limit is. Then minus the current carrying amount. This is actually the carrying amount that we are recording. All right, so this one was just for us to put our limit on. So this minus the current carrying amount, 011. Okay, I hope it makes sense. I'm going to explain again. The reason why we have historical is to limit this figure. This figure cannot be more, so this must not be more than the historical carrying amount. Hence, we use the historical carrying amount to be the one that we compare to the actual carrying amounts that already had impairments. Okay. And then from there, we'll be able to calculate our reversal. So our reversal is going to be 8,420,000 minus 7,991,011. So yeah, then we come here and bring the reversal. So it's 428,989. So compared to the impairment before, you can see the impairment was actually 416, eh? So it must not be more than that. So it makes sense. We have reversed it now to that price. Okay, so the actual carrying amount is actually coming back there after everything. After everything, it comes back to the historical costs. 420. That actually becomes my carrying amount. Okay, I hope this makes sense. This is very important. Most of the time we deal with the impairment loss. In this question, what I like about it, there was both impairment loss and reversal. So we had a loss there in red, we had a loss, impairment loss. We also had a reversal, and you guys saw how the reversal is actually limited. So yeah, that's basically how it works. Now we have to go and account for this. Now, what affected us here, which affected our carrying amount during the year, not 2022, guys, not 2022, during the current year, 2023 financial period, is the depreciation. And remember, this is the actual depreciation. This one is just for comparison purpose. The carrying amount, the actual, let me even put it as actual, the actual carrying amount. This is the actual one that you are recording in our books. Ne? So that's the one. So this depreciation is what it happened during the year, and the reversal. Those are the two that we're actually accounting for in our journal. All right. So let's go do that. Oh, we didn't leave enough space. It's okay. We'll just try to squash everything in. So depreciation, guys, we know how our depreciation journal is. Debit the depreciation, that's the expense. Okay, it's profit and loss. And then credit the accumulated depreciation. Statement of financial position. Guys, the narration is just that you're recording your depreciation. I think that's what you can do. Then the amount has already been calculated, is sitting in calculation number 2. The depreciation for the current year, which is this figure here, it's 508,989. 508,989. 508,989. Right, and then we have the reversal. Reversal is an income, right? So this is going to be, it's going to be credited. The impairment loss reversal is going to be credited, while accumulated impairment will be debited. Okay, so we have here accumulated. You can write in full impairment. This impairment is on what? On manufacturing plants. Okay, statements of financial position. And then we have impairment loss. This is not an expense, but a income. Impairment loss reversal. Okay, so this is profit and loss. All right, then we take the figure as is. This one is coming from calculation 2. Right, and then the other one, I think we had to calculate it here. Yeah, this one we had to, okay, we did it there. So yeah, the impairments, all the calculations has been done. We're just taking the figure. So it's 428,989. 428,989. 428,989. 428,989. Calculation 2. And you guys can just do the narration, basically explaining that we are recognizing the impairment reversal that we had during the year. This was limited to 30 September 2023. That is why we did not do the journal in the 2022 financial period, when it was actually constructed, when it was bought, and the rest of them. We didn't do that because we are not told to do journals for that. Okay, so guys, that is it. That's all the journals that actually affected us during the year. During the year, guys, I keep insisting this. Journals are important, that you know which journals that you're doing. If you do not know the particular journal that you're dealing with, if you do not know the particular journals that you're dealing with, the period, you will not be able to give us the correct journal. That's why I always say put your date so you give the correct journal. So then, guys, that is that. A is done. Right. So you saw the amount of work that we had to actually do. The reason why I'm taking much time than you will do is because I'm explaining, right? I'm explaining this thing, so I take more time compared to you. When you do it alone, you will be faster. Okay, so you must also work on speed because they're not only testing knowledge, they're also testing speed. Now, if you just joined us, please tell us on the comment section who you are and where you're watching us from. Let's get to know you. If you happen to have questions while I was working on this particular question, please put your question on the comment section and I will answer you. Remember, this video is being premiered. I am right here with you, so I'm answering all questions. Okay. And also, if you're just joining, make sure you subscribe to the channel. Please press the subscription button. Guys, it's free of charge. It's free. And most importantly, like the video and share it with all the groups that you know, wherever you can find your FAC3764 students. Please share the link with them. And also you can post it on your status. Let's get the message across. Let people know that we're having a revision going on as they are writing. All right. Yeah, like the video, comment, ask your question on the comment section. Let us go to the next question. Right, the next one says disclose. This one we are doing a note. Disclose the property in Matetiele in the accounting records of Koro Limited for the year ended 30 September 2023 in accordance with the requirements of only IS 8 accounting policy changing estimates and errors. At this point in time, guys, we don't know what exactly is the issue here. We don't know if it's a change in accounting policy, if it's a prior period error, or if it's a change in accounting estimates. So we need to go and read the scenario to find out which one is actually affected. Then we're going to go and do the notes. All right, so let's go. Property in Matetiele. That's what we're looking for. All right, let's read. So it says in 1 January 2021, Koro acquired a property in Matetiele for an amount of 4,050,000, while land was 850 and building was 3,650,000. The property was purchased with the intention to be rented out. Okay, so it was purchased with the intention to be rented out. A rental agreement was signed with Tucoms Limited, a distributor and wholesaler of inverters and solar panels. On acquisition date, the building had an estimated useful life of 20 years and an insignificant residual value which can be ignored. The building was ready for use as intended by management, as well as brought into use on the acquisition date, which is January 2021. During the 2023 financial year, the board of directors of Nkoro decided to change the investment property accounting policy from the cost model to the fair value model to present users of financial statement with a more realistic market value of the investment property. The following fair values of the property in Matatiele were received from an independent sworn appraiser for the respective years. So we have here land, buildings, and their total. All right, so basically what's the story here? So we had an investment property because its intention for the property was for rental, right? So it was not for personal use, but it was for rental. So it's not an owner-occupied property, it's rather an investment property. But they used to use the cost model. Now, using the cost model means that we are actually going to record our investment property at carrying amount, meaning cost minus accumulated depreciation. So they are changing that method to the fair value model. In the fair value model, there is no depreciation, and we account for the asset at fair value. So we must calculate the fair value and account for the profit. So there's basically fair value adjustments, right? Well, with cost model, there was no fair value adjustment, it was just depreciation, and we're carrying it at carrying amount. So yeah, that's basically what happened. Now we're changing. So this is definitely not an estimate because it's a whole a whole model that is being changed. It's a whole model that is being changed, right? If it was just the way of calculating a depreciation method or something, or a useful life, or a residual value, something that would have been estimates. But because it's the whole model of how we account for an asset, how the asset should be carried, this is bigger than that. So it is a change in accounting policy. So we have a change in accounting policy that we're going to deal with. Now we need to make sense of this. We were using cost model, meaning there was depreciation before, right? So we had depreciation before now, and now we are no longer going to have depreciation. So we are going to decrease those depreciation that we are accounting for before, add the values back to the assets, all right? Now, and also account for fair value adjustment because we are now moving to fair value model. So there's going to be increase in fair value adjustment, decrease in the depreciation, adding it back to the value, and of course the tax effects, tax effect as well. And what happens to profit? Depreciation that is going to be decreased will increase the profit, but also accounting for fair value adjustments. Okay, so that's what we're doing. This should be easy, guys. Changing accounting policy are always easy. So let's get to it. Let's get to it. So this is my question B. I'll do it here. Question B. We are doing changing accounting policy notes. So I'm basically doing notes for Coro Limited. I'm doing notes for the year ended 30 September 2023. Okay, then notes, I'll just call this note number 1. So I'm doing change in accounting policy. All right, now whenever we do a change in accounting policy, we must always tell what caused this change, what happened, what was the nature, all of those things. So usually we'll take this information, copy and paste it from whatever we have here. So I always tell students just copy and paste this. So starting from here. Okay, so you're gonna copy and paste all of those that I've just highlighted there. During the 2023 financial year, the board of directors on Coro decided to change the investment property accounting policy from so they changed the whole accounting policy. I think they even mentioned it. They changed the accounting policy from the cost model to the fair value model to present users of financial statement with a more realistic market value of the investment property. So that will be the first thing that you're gonna do. We take that and we put that down as is. Then we're going to say, because now I have information for 3 years, so this is going to be accounted for retrospectively. So you're going to now tell us that this change in accounting policy was accounted for retrospectively. So this change in accounting policy was accounted for retrospectively. Okay. Per period figures were restated. Retrospectively, and comparative amounts have been restated. Comparative amounts have been restated. Okay, and the effect is as follows. Okay, so now we're gonna deal with it. So how many years are we dealing with? We have 2023, the current year, the prior year, and the other year. So 2023, 2022, and 2021. So we have here 2023, 2022, and 2021. Now remember, it always affects two statements: statement of profit and loss and statement of financial position. Let's start with profit and loss. First thing first, we're using the cost model. We're depreciating. Now we're no longer going to depreciate. So when we are changing, when you're doing change in accounting policy retrospectively, we actually want to go back to make it look like this has always been there. This new method has always been in existence for the past 3 years. Okay, so that's what we're actually doing. So I'm going to go back and decrease the depreciation that we once recorded. I'm also going to increase the fair value adjustments. Okay, so it's going to be increase as if it has always been there, né? So increase in fair value adjustments, then decrease in depreciation, right? Then, of course, if depreciation decreases, that's an expense. It means there'll be increase in profit. And if profit increase, there'll be increase in taxation. So increase in tax, income tax, expense, and increase in profit. Yeah, so then, of course, that, and then because we are decreasing the depreciation, we're adding back the depreciation amount, and also we're increasing the fair value adjustment, it means the investment property itself will increase. The investment property value will actually increase, and of course, deferred tax and equity will increase. Okay, so increase in investment property, increase in investment property, this will increase tax. But what is the effect of SARS in this thing? What is SARS saying? Did they say? Okay, let me see. Let me look down. Maybe accounting policy. Let me read the accounting policy, because SARS must tell us something, so we know how to account for the taxation. Let me read the accounting policy. Mkoro accounts for inventory at the lower of cost or net realizable value. Mkoro account for property, plants, and equipment using the cost model. Depreciation on property, plant equipment is account straight line method over the estimated useful life. Mkoro accounts for intangible assets in accordance with the cost model. Amortization is accounted for with straight line method over the estimated useful life. Okay, here. Before change in accounting policy, Coro accounted for investment property according to the cost model, whilst depreciation on investment property was accounted for using straight line, okay? Method over the estimated useful life of the assets. After changing accounting policy, Nkoro account for investment property according to the fair value model. Okay, we get that. What about the decision on tax? All right. The South African Revenue Service allows an annual building allowance of 5% on the property in Matatela. Okay. According to section 13(1) of the income tax on a straight line method, not apportioned. The change, thank you. The change, sorry guys, I'm trying to get my pen to write. It was doing well, now I don't know what happened. Just give me a minute to get it right. While we are doing that, please make sure you're liking the video. Make sure you are sharing the link with someone. Share on the groups that you are coming from. And if you have questions, please don't hesitate to put it on the comment section. Okay. Right. The change in accounting policy on the property Matatela has no impact on tax legislations. Okay, is that the property we are busy with? It has no impact. The South African normal tax rate is 27%. So basically they're not they're saying this one has no impact on the on the tax legislation. So we're just going to deal with the changes accordingly. So it's just going to be a deferred tax change, not because they're not accepting this, but because of the change, how the item, you know, all of a sudden changed its figure. All right. So we're gonna have increase in deferred tax. In deferred tax liability. And then this was going to increase in equity. Okay. And we are used to inventory. Né? This time around, they're giving us something different and not the inventory we are used to. Okay, and then comes increase in returned earnings. I'll just write this like this, please write in full. Returned earnings at beginning of the year. Guys, when you get a note like this in the exam, please celebrate, because wow. Okay, anyways, let's do calculations. Always label your calculations. Now remember, I already had calculation numbers just so not to confuse them. So here it was calculation 1 and 2. I'm just gonna continue to say 3. Okay, so just not to confuse them. Right, so I want to first of all I want to calculate the increase in fair value adjustment. So here I'm comparing fair value adjustment. That should be easy. I'm just comparing year to year. The adjustment year to year. Okay, let's start with 2021. So this is my property. So I'm going to use these figures. But 2021, I'm going to compare it to the actual cost. Né? I'm going to compare it to the actual costs. So we have 4,670,000 and 4.5. I'm comparing to 4.5. 4,670,000 minus 4,500,000. So that will be 170. Then number 4. I'm now going to compare now I'm in the 2022. I'm not going to compare this with this. 4,780,000 minus 4,670. 4,780,000 minus 4,670,000. So that's 110,000. Then I'm going to compare 5,050,000 and 4,780,000. So that will be 270,000. Okay, so these will be my fair value adjustments. Let me just write here. These are my fair value adjustments. Okay, so we're going to come and put them. So this was the very first one we did was the 2021. It was 110, 170. 170,000, 110,000. Then the 2023 is 270. Okay, so those are my fair value adjustments. Then let's go to, let's put the number 3, 4, 5, so they'll know where we're getting it from. Then the depreciation. Now we're going to depreciate the assets. Remember, with depreciation, it's only the buildings that are actually depreciated. Okay. So it's only the buildings that are depreciated. Let me go to 2021. So in 2021, I just need to know the value of the building only. So my building was 3,650,000. Okay, there was no residual value. The set is insignificant. The useful life is 20 years. When was the asset available already for use? Also on 1 January 2021, while the year ends in September. January 2021. January 2021. So in 2021, the cost of the building is 3,650,000. Remember, land is not depreciated, over 20 years, which is the useful life, January to September. So January, February, March, April, May, June, July, August, September. January, February, March, April, May, June, July, August, September. That's 9 months. So 3,650,000 divided by 20 times 9 divided by 12. So I'm actually getting 136,875. Okay, that is 2020, 2021, then 2022. So it's straight line. My depreciation is straight line. 2023, I'm just say plus 2023, 2022 plus 2023. The depreciation is straight line, so it's still the same. It's the same every year. 3,650,000 over 20. 3,650,000 divided by 20. That would be 182,500. So it's fixed every year. Right, so let's go put this. The 182,500. So it's what is happening here? We're decreasing this next to increase the actual amount. So we are adding it back. So 182,500. 182,500. Then this one is 136 because this one was only for 9 months. 136,875. Okay, so this was calculation 6 and the other one is 7. 6, these two are 7. They are fixed every year. Then now we have to calculate tax. So please pay attention to how we're going to do tax. Remember, the fair value is going to attract capital gain implication, while depreciation does not attract capital gain tax. Capital gain tax. So this is how it's going to be. Let me do it in a different color. Oh, I didn't write this is depreciation. Then now we're going to deal with taxation. Okay, let me do 8. So that's how this is how we're going to do tax. The fair value, let me start in 2021. The fair value adjustment, so taxation is going to be like this. The fair value adjustment in 2021 was 170. This is going to attract capital gain. So times 80% times, what was our tax rate at this point? I believe it was 27%. I believe it's 27%. Yes, tax is 27%. Capital gain is 80%. So 27%. Plus the depreciation for 2021, 136,875. This only attracts the normal tax. Right, so our taxation figure will then be the fair value adjustments is 170,000 multiplied by 80% multiplied by 27%, right? And then plus open brackets, 136,875 times 27%, close brackets. So I'm getting 73676, 73,676 basically. Yeah. And then we go to 2022, basically the same thing. 110,000 fair value adjustment attract capital gain, plus the depreciation, which was 182,500 only tax. Okay, 110,000 times 80% times 27%, plus open bracket, 182,500 times 27%, close bracket, and here I get 73 and 35. Then for 2023, come on, pen, come on, come on. 2023. Right, so we have the fair value was 270 times 80% times 27%, plus the depreciation 182,500 times 27%. So this was one of an exam here, because I can see the amount of calculation that needed to be done. Wow. What an exam. Anyways, 270,000 times 80% times 27%, all right, equal, plus open bracket, 182,500 times 27%, close bracket, and in total I have 107,595. Okay, so that's actually my taxations, all three of them. That's my taxation figures. So let's go put it down. So it is 73676. Calculation 8. The next one, 73035. Then the last one is 107,595. Okay, so yeah, that's basically it. That's basically it. Okay. Now let's calculate the total. So you add the 2 and then you minus the taxation. Okay, I'll start from 2023. So 270,000 plus 182,500 minus 107,595. So this will give me 344,905. The next one, 110 plus 182,500 minus 73 and 35. This will give me 219,465. Right, then we have the last one, 170,000 plus 136,875 minus 73,676. So this will give me 233,199. Okay, so yeah, when we get here, it's basically the text is still the same. The text, I'm just copying that 595. Every other thing is the same. 344,905, 73,035, and then 219,465, 73,676, 233,199. Then the investment property increase is the two values added together. So let's do that. So 270 fair value plus adding back the depreciation 182,500. So this gives me 452,500. Right, we do the same for 2022. We add 110,000 plus 182,500. So I'm getting 292,500. The last one, 2021, 170,000 plus 136,875. Added together, it gives me 306,875. So yeah, that's basically it. And then opening balance. So this becomes the opening balance here. This becomes the opening balance here. 233,199, 219,465. Guys, and that is it. Guys, you see how much of a giveaway this note is. Usually this note is very, very simple. All right, if you do have questions, please go on the comment section right now and write your question down. Also, just take a break of a water. Not a long break, just drink water because we're still here. We are very much here. Right, so this was done too. So please go on the comment section, ask your question. And if you're understanding and everything is going well, just tell me on the comment section, Naomi, all is well. We are together. Or I'm understanding, something like that. Just say something on the comment section. Again, for those of you who are just joining, please like the video, subscribe to the channel, share the link with some people, share on the group, share on all the students that you know. And yeah, and if you're just joining, let us know on the comment section who you are and where you're watching us from. Okay, right, all right, let's keep those comment section busy. Let's keep the comment section busy. Let's like, let's subscribe. Now let's go to the last question of question one, last part of question one. This one says advice. So here we're discussing now. Advise the Chief Financial Officer, the CFO, on the accounting implications, including measurements of the decision to sell the Zwanga division in the accounting records of Nkoro Limited only on, guys, remember our limit is 1 July 2023. We are limiting this to 1 July 2023. Limit your measurement discussion to 1 July 2023. Support your discussion with calculations where applicable. Do not include any tax-related discussions or calculations. Avoid tax completely. And then, so it says 16 plus 1 mark for communication, that's 17. So we are discussing, basically. So let's go and read so that we take it from there. So the Zwanga division, right, what would they have to say here? The Zwanga division of Nkoro provides consultation services within the South African market. During the 2023 financial year, Nkoro's board of directors took a strategic decision. They took a strategic decision to sell the Zwanga division. This is the 2023 financial period. Within a single transaction, so that makes it a disposal group. If it's going to be sold within a single transaction, it's a disposal group. On 1 July 2023, the division met all the criteria to be classified as a disposal group held for sale in accordance with the requirements of IFRS 5, non-current asset held for sale and discontinued operation. The disposal group consists of the following assets. So we have inventory, windy trademark, and vehicle. So inventory is a current asset, windy trademark, that's an intangible asset, and vehicle, it's a PPE. Tangible assets. All right, so there we are. And then they're sending us to the notes that refers or give us extra information about the assets in particular. The fair value less cost to sale of Zwanga division was determined to be that and that on 1 July 2023 and in September. Remember, the discussion focuses on 1 July 2023 only. We're not going to look at after that. Ne? Then note number one, this is now, these notes are referring to the assets above. Note number one, the inventory was acquired at a cost of 300,000 and had the following net realizable values at the end of each period. We are only interested in July. So the net realizable value is 310. Okay, remember for inventory, we actually take the lower of cost or net realizable value. We actually have been told on the accounting policy as well, just in case you have forgotten. Then note number two, the windy trademark was acquired from Gadget Galore Inventors for an amount of 1,100,000 on 31st October 2022. On acquisition date, an indefinite useful life. So already it has an indefinite useful life, and the residual value of nil was allocated to the trademark. Now, when an intangible asset has an indefinite useful life, there are two things. First of all, there will be no amortization, and for tax purposes, it's going to attract capital gain tax, but we're not dealing with tax. So just to come back here, it's not going to have amortization. There won't be amortization on such an intangible asset, and it also attract impairment. It attract impairment as well. Okay, almost left that out. Attract impairment. So we have to actually test it for impairments. On the 1st July 2023 and 30 September, the windy trademark had a recoverable amount of that, and the other one for 30 September, which we're not interested in. And then 2020, sorry, note three, the vehicle was acquired. This is the vehicle now. Vehicle was acquired on October 2021 for an amount of 1,250,000. The vehicle was available for use as intended by management, as well as brought into use on acquisition date. On acquisition date, the useful life of the vehicle was estimated to be 5 years. Useful life with an insignificant residual value, which can be ignored. On 1 July 2023 and 30 September, the recoverable amount of the vehicle was determined to be that. We are interested in only July. We're only interested in July. Come on, pen. All these fancy laptops and their pens now are reacting. Okay, all right, so it's back there. So guys, that's the information and you're meant to discuss. I actually feel like this is very, very easy. So I am going to do the discussion with you guys. However, and please don't start your discussion with a calculation. Please don't do that. Always start with a theory. So whenever you're doing discussion, so you're always going to start with the principle basically, né? So it's going to be your principle. All right, principle as per requirements, You don't take the whole book and write it down. So here we are talking about non-current asset held for sale, right? For a disposal group. So you only talk pertaining to that, and we're only talking at initial recognition because it's 1 July 2023. That was when it actually qualified. All criteria were qualified. So it's only initial recognition. So your principle that you're going to talk about, you'll have to just talk about on that only. Then, secondly, now you're going to discuss, this is where you spend most of your time. So on the discussion, you have to link scenario. You link the scenario to the principle. So the principle and the scenario must be linked. So you need to speak the scenarios, mention the names, the date, mention exactly what's written on the scenario. And 3, conclusion. So you then conclude, either agree or answer to a question or whatever it is that they had asked you, you're actually coming to either agree, disagree, or answer to a question. That's how it's done. This is how you always follow it, right? So you will start it first, and then the calculations will come along on the discussion. While you're discussing, you do the calculation. Please follow this. This is how it should be done. But for the sake of the class, and for me to be able to discuss well, I'm going to do the calculation first, and then I'll do the discussion. But remember, this is how it should be done. Just for the sake of the class and for us to see the figures, to actually see them well, and be able to explain them. So I'm going to start with the calculation first. Okay, then we'll do the discussion. So usually when I teach it, I usually tell you guys do step 1, step 3, and all those things. But now I'm just going to do it in a table. I feel like it's going to save us time and energy. And it is much clearer to see and to understand. Right, so here I'll have my carrying amount. Carrying amount. This is before impairments. Before impairments. Then I have my impairment. That is if we have impairment loss. Then I have my actual carrying amount, which will be my either fair value less cost of sale. So I'll just call it carrying amount after impairments. Okay. Then I have my disposal group item on the side. All the items that makes up my disposal group. So we started with inventory. Okay, so I want to calculate my carrying amounts on inventory. Carrying amounts. So we said the cost is 300 and the net realizable value is 310. So we want to use the lower. With this is going to be, let me just do this, lower of carrying amount or costs and the net realizable value. So in this case, the lower will be 300, right? Which is the cost. So my carrying amount will be 300. The other one is 310 is more. Then we have the windy trademark. Windy trademark. Okay. So what's the story here? I want to go back to the story that we've been told on the windy trademark. Right, so here it says the actual cost is 110. It was acquired in October 2022. Okay, and it has an indefinite useful life, so there is no amortization. Okay, so it's basically 110 that will keep you using. And on 1 July, it had a recoverable amount of 125,000. So the cost is 1,100,000. Its recoverable amount is it's 1,025,000 as at July 2023. So actually it was impaired already individually before we can actually transfer it to non-current asset held for sale. It was first impaired. Okay, so yeah. So we're saying here, I'm going to do this in red. The cost was 110 million and its recoverable amount is actually 125 million. Okay, so it was impaired. So it was impaired before transferal. Before transferal. Therefore, the carrying amount that I'm going to account for is going to be the 1,025,000, already the recoverable amounts. Okay. Then the last one is vehicle. The last one is vehicle. So what's the story with vehicle? Vehicle. Did I skip it or there? The vehicle was acquired in October 21 for 1,250,000. This one, of course, has depreciation in it, so it was available for use on acquisition date. That's October 2021. On acquisition date, the useful life of the vehicle was 5 years and an insignificant residual value. On 1 July 2023, it also had a recoverable amount of 820. So we need to know, first of all, the carrying amount and then compare the carrying amount to the recoverable amount, which is 820. So this was available for use in October 2021. So we have to calculate that up until where we are right now. We have to calculate depreciation from that time up until July 2023, right? So yeah, let's do the calculation. So the carrying amount actually would be equal to, so it was 1,250,000, right? The carrying amount, so minus, let me do big brackets, minus 1,250,000 divide by 5 years, multiply by how long have we had it? So let's go aside to do the how long we've had the asset. 1 October 2021 up until 30 September 22, 12 months. Then 1 October 22 up until is it 1st July? Yes, 1st July 2023. 1st July 2023. So that is October, November, December, January, February, March, April, May, June. That's 9 months. Okay, I'll do it again. October, November, December, January, February, March, April, May, June. We can't count July because it's the beginning. So it's 9 months. Right, so 12 plus 9, that would be 21 months has passed. 29 months, 21 has passed. So I'll multiply this by 21, divide by 12. I hope it's clear what I'm doing. So let's do the small bracket first before we close the big bracket. Before we do the big bracket, 1,250,000 divided by 5 times 21 divided by 12. Okay, so that's 4. That actually let me just do 1,250 minus 437,500. So my carrying amount is 812,500. Right. Then the recoverable amount is actually given as 820. And as you can see, the carrying amount is actually less than the recoverable amount. So there was no impairment. No impairment. I feel like with all this calculation we're doing, one now has a lot to actually say on the discussion. Okay, but please don't do this approach. It's a very scary approach. It may take so much time and then you don't end up discussing well. But for the sake of the class, I just want you guys to see what I'll be saying on my discussion. I want you to see where it's coming from. But if you are writing an exam, just discuss once. Discuss everything that you're doing in the calculation. Explain it rather. Okay. So therefore, my carrying amount is still the one we calculated, which is the 812,500. So that will make up my carrying amount in total. So I have here, I'm going to add them together. 300,000 plus 1,025,000 plus 812,500. So this is 2,137,500. So that's my carrying amount. And then I'm gonna compare these to the fair value less cost to sale. If the fair value less cost to sale is actually low, I was gonna measure there. So normally when we're doing steps, first step will be what? Calculate your carrying amounts. Step 2 will be so step 2 and 3 is here. Step 2 plus step 3. So step 2 is that you calculate the fair value less cost to sale. Here is where you calculate your fair value less cost to sale. Now here you don't look at recoverable amounts, it's only the fair value less cost to sale. You don't look at the value used because of non-current assets held for sale. Okay. Then step number 3 is measure it. This is where you measure at lower of carrying amount or fair value less cost to sale. Okay, so that's step 1, 2, and 3. And then step 4 is where you calculate. So this is step 4 and 5. Step 4 plus step 5. Step 4 is where you calculate impairment loss. And step 5 is where you allocate impairments. So when you do it in a table like this, it's faster. All of them are faster. Okay, so this is me explaining so that somebody can understand how these things are done. Anyways, so we first of all get our fair value less cost to sale of the group. So we come here back to the information. The group 1, I think it was mentioned first here. The fair value less cost to sale of the Zwanga division amounted to this and that on July and 30 September. So this is it. 2,087,500. 2,087,500. 2,087,500. The difference between the two is going to be your impairments, né? So basically you can see the carrying amount is bigger than the fair value less cost to sale. So you're basically saying 2,137,500 minus 2,087,500. So it's 50,000. So my impairment is 50,000. Right? That's my impairment loss. Then allocation of impairments. Now, with allocation, you only allocate what is within the scope of IFRS 5. So inventory is not, so this is not in IFRS 5 scope. So you don't allocate, and therefore the carrying amount after allocation, it's still 300,000. Okay. Then these two now, you're going to have to allocate the true. I'm going to do this on the side. So you have to calculate that you allocate the true and you have to find the total between them to do the allocation. So let's call this let's call them A. So A, I'm going to do the total first. So I take them 1,025,000 plus 812,500. So 1,025,000 20,000 plus 812,500. This gives me in total 1,837,500. Okay, and then I'll do my allocation accordingly. So it's gonna be the first one, windy mill, windy trademark. It's 1,025,000 over the total 1,837,500 multiplied by the actual impairment, which is 50,000. Okay, then C, it is 812,500 over the total, which is 1,837,500 multiplied by 50,000. That's how you do your allocation. So we're saying 1,025,000 divide by 1,837,500 multiplied by 50,000. So the allocation for the windy trademark is 27,891. Then I'll just find the difference with the 50,000. The other one is 22,109. Okay, that's how you're going to allocate the other one. Right, so now that you have your figures, so we're not going to bring them here. The first one is for the windmill is 27,889, one which is B, and then the other one is 22,109. 109, that will be C. And then this, so you are minusing them, just like this is also being minus. So you're taking this minus this to get this same thing. So yeah, that's how you do it. So 1,025,000 minus 27,891. This gives me 90. This gives me 997,109. Then the next one, 812,500 minus 22,109. This gives me 790,391. If you add the three together, you come back to this value. Okay, so basically that is what you want to do. This is what you want to discuss. This is what we want to be discussed. Okay, so whatever you're going to discuss is actually coming from here. That's how we do it. So I'm going to be very, very quick in the discussion. I don't think I'm going to talk a lot of things. I'm just going to basically tell you what to do or what to focus on. Yeah, we're basically just going to talk about what to focus on. So the first thing first, you're going to start okay, so it's a discussion, basically advising them. First thing first, you have to talk about the fact that the directors decided to sell. You'd start here. Use the information in front of you. On the 31st, on the 1 July 2022, the division, where the directors decided. During, yes, that's where you're going to start. During 2023 financial year, Chorus Board of Directors took a strategic decision to sell the Zwanga division within a single transaction. All right. And on the 1st July 2023, the division met all the criteria to be classified as a disposal group held for sale in accordance with the requirements of FAC 5. See, this is where you're going to start. From that until here, you will start with that. You can even copy and paste that information. That will be your starting point. Then, now that all criteria have been met, okay, so now you have to talk about how you're going to recognize this. So on 1 July, 2023, there's Zwanga division upon meeting all requirements to be classified as held for sale. Upon meeting all requirements to be classified as held for sale, will be transferred to non-current asset held for sale. Okay, boom. So that's basically what you're going to do. And then secondly, now you have to talk about the initial measurements. Okay. We already talked about classification to be classified as non-current asset for sale. Then initial measurement on 1 July 2023. Okay, so the non-current assets, let me just cut in short. Non-current asset held for sale of the disposal group will be measured at the lower of carrying amount or fair value less costs to sell. Okay, now after that, the carrying amounts of the individual assets within the disposal group will need to be calculated and added together. Okay, so this is when you start to talk about the individual assets. The inventory is measured at lower of costs or net realizable value. All right, then you can use the calculation, see calculation above. Okay, the next one, windy trademark. The windy trademark. Okay, so this is an intangible asset with an indefinite useful life, and intangible assets with an indefinite useful life, and therefore has no amortization. However, it must be tested for impairment. Okay, then see calculation above. I've already done calculation. Right, lastly, the vehicle. is carried at its carrying amount or cost model, and therefore the carrying amount of the vehicle, carrying amount of the vehicle should be calculated. Oh, sorry guys, I'm trying to move and my screen is stuck. Sure. Okay. Where was I? The carrying amount of the vehicle should be calculated at 1 July 2023 and tested for impairment too. Impairments before being transferred. Okay, see calculation above. Right, then so here we talked about so here we talked about the carrying amount. So the total carrying amount now after everything as calculated above is, so the total carrying amount of the disposal group as calculated above is, so we can put in the value. The total amount is 2,137,500. 2,137,500, which is higher than the fair value less cost to sale of 2,087,000. Okay, therefore the impairment loss of 50,000 being the difference. See calculation above. Should be allocated to the assets within the scope of IFRS 5. Okay, see above, I've done it already. Right, so you see my calculation now, I'm keep making reference to see above because it makes sense when I do it here. Now I'm just explaining what I'm doing. Please give better explanation, but you're just basically explaining what you have done. So yeah, guys, that is it. That is the question that we were asked to do. The last part of the question of what we were actually asked to do, that is basically it. So we can say C is also done. Just make sure you touch on everything. Make sure your discussion is much more detailed. I think I'm just trying to rush through it at this time around because I have already done the calculation. I was already explaining what I was doing. So it's really just up to you now to just, make sure you give full sentences and in detail. Guys, put your discussion in so much detail, like so much detail. Explain everything, even if you have to actually explain the calculation, better do that. Okay. Yeah, so that's basically it, guys. So question 1 is done. That's a 50 marks. So guys, it is time for questions. Let's go to the comment section and ask our questions. Let's ask our question or comments. I'm gonna leave like 5 to 10 minutes time for you guys, to ask questions, also, maybe stand, stretch a little bit, drink some water. So we are still together. Drink some water, stretch a little bit, ask those questions that you have on the comment section. If you haven't liked this video yet, please go and like the video. If you haven't shared, please share. If you haven't subscribed, please subscribe. Share the link with other students. Let's have more people coming in to watch. And then subscribe, like, comment. If you are just joining us, tell us on the comment section who you are and where you're watching us from. Right, so yeah, this is basically time for our questions. I'm going to leave space for questions. So please put your questions on the comment section and we'll continue with question 2 thereafter. Okay, guys, as you are joining in, please tell other students as they're joining in to like. And yeah, so we're giving this time 5 to 10 minutes to ask any question pertaining to what we did on question 1. And remember, on question 1, we touched on property, plants, and equipment. We touched on intangible assets, impairment of assets, both impairment loss and reversal. We touched on operating lease. Yes, we did operating lease as well. We touched on changing IS8, changing accounting policy. We also now touched on non-current asset held for sale. So basically, yeah, those are the topics that has been touched on so far. Okay, so question time. Let's put on a question. Okay, guys. Yeah, I decided let me put this in two parts. Let's rather have this in two parts. So we will do part two. It'll be live on Sunday. Sunday at 6 p.m. We'll do part two so we can give it proper energy and attention. Yeah, than putting everything once. So this time you guys will master what you've just done, part one. And then the other parts of the section, we're gonna call this part two, which will be done on Sunday at 6 p.m. Okay, that will be question two of the same question. So guys, those of you that are here, remember to come back again on Sunday at 6 p.m. so that we finish it off. At least it's giving you more time to practice and master what we have done in class. Thank you, those of you who have liked the video. Thank you, those of you who have subscribed. And those of you who have shared the link, I really do appreciate. Those of you that are always joining my videos, always, every time I do any live premiere, you're always there. Thank you so much. I really appreciate your support. I appreciate it all. And I hope these videos are very helpful to you guys. This is my own way of giving out back to students. Yeah, and I cannot stop this by talking about EUREKA without talking about EUREKA. So guys, I do run a tutorial college where I teach Unisa students. So these are some of the things I do: FAC3764, AIN 3701, 2601, and the other module FA6701, all the modules that you know, every module on BCompt and others, we have them. We have different lecturers as well that we're working with. So if you want to register for classes, you can register through EUREKA Tutoring. I have posted our detail already on my post, but I will put it again. I'll put the details again under the description. So if you do wish to register for tutorial classes, our classes are done weekly on Zoom. So it's online classes, fully online college. Our classes are done weekly on online, and then we do a lot of revisions throughout the year. For assessment, every time there's assessment, we do a revision, to help where we can. Yeah, so yeah, that's what we do. Please do tune in. Even those of you that are doing still second year, or you know people that are doing their first and second year, we also do help them. Please let them know about EUREKA tutoring. Yeah, I will put the details on the description. Please do contact us, register with us, all your modules, and we will take care of you from, of course, when the year starts until the end of the year. We will be with you every week. We are with you. Okay, guys, thank you so much for joining in and tuning in. I'll see you guys again on Sunday, 6 p.m. Then we'll finish together. Okay, so let's eat the cake piece by piece. All right, let's eat the cake piece by piece. If you still haven't liked, please like. If you haven't subscribed, please subscribe. Guys, we are on our road to actually 10K. So we are on 4,000 subscribers. Let's first push to 5,000 and then we'll get to the bigger side of things. So let's push to 5,000. We are currently on 4.2. So we need 800 more subscribers so we can reach 5,000, and we push like that. So guys, help me push this channel. Let's keep the channel alive because it does help people. Again, I've done videos on different topics like groups, like income tax and other topics, so do check it out. I've also done videos on accounting systems, Pastel and Sage so far, and other videos on business, so you can also check them out. Sit on this channel, check things out, and share it with your families and your friends. Okay guys, thank you so much for coming through. I'll see you guys again on another video. Thank you for tuning in Accounting with Naomi. Bye. Love you guys. Mwah, mwah. Bye.